welcome to this Bell Direct Weekly Update. I'm Julia Lee, an equity strategist at Bell Direct. And this week we have seen the volatility in markets continuing. So let's start off with asset allocation, and we'll start off with having a look at Morgan Stanley. Morgan Stanley is saying that in terms of rising yields as we are seeing now, that tends to be a positive backdrop for equities, except when valuations are stretched. In fact, they did change their rating on equities in June and August to better weather the volatility in markets, and they are hesitant to cut further as they do see the one-year view on equities still being constructive. That's due to a number of reasons, including solid data continuing to come through from the US, loose monetary policy globally, a trade risk stabilizing. In fact, the rising oil and inflation that we're seeing supports the case for global reflation, and the recent sell-off that we've seen has taken some of the froth out of markets. It's neutral equities, and it doesn't think that Australia's too bad. In fact, they say Australia does look okay in the short term. The defensive nature of the market should attract some safe haven flows, and in the area of fixed interest, it prefers Australian bonds to international bonds. Macquarie also having a look at the trade war and potential scenarios. 4 potential scenarios and the impact on commodity investing. In the first case, China stimulates, which would be good news for iron ore, steel, scrap, as well as coal. In the area of scenario 1, this is where China attempts to offset the trade war risk by deleveraging as well as delivering targeted tax cuts and investing into infrastructure. That, of course, would be good news for steel as well as growth and imported raw materials. And the second scenario is a trade resolution, and they say that in this scenario, look at buying metals but holding or selling steel as well as iron ore. Any resolution in terms of China that promises clarity and resumption to growth promise the reversal of recent price performances. In the third scenario, we see short-term or ongoing global trade uncertainty. In this case, they say buy bulks, which is seen as a defensive play, and avoid some of those growth areas like metals. And in the fourth case scenario, which would be the worst case scenario, this is long-term global trade war persisting for months or years, in which case they say to run to the safe haven area of buying gold. Having a look at City and Tourism Watch, and we have seen some strong numbers coming through for August. In fact, outbound departures grew by 6%, which is above the rolling 12-month growth rate of 4%, and we also saw inbound arrivals growing by 6%. Given the above trend growth in this space, they do see favourable conditions for companies exposed to Australian tourism. This graph shows the link between short-term visitor arrivals and the Aussie dollar, and you can see that there's a pretty strong link there, although there is a bit of a lag. So some tourism ideas would be to buy art and leisure as well as event hospitality. UBS looking at supermarkets, saying that we are seeing an easing in the rate of deflation, and we've certainly seen that come through in Coles quarterly sales numbers. In fact, easing deflation or inflation is positive for sales margins as well as valuations, and in fact, in periods of top quintile inflation, Australian listed grocers have outperformed the market by around about a massive 29%. Morgan's recently had its Queensland conference, so ending today with some stock picks. Morgan's likes Apollo Tourism and Leisure, saying that it is well placed in the current financial year and that growth in Europe is just getting started. One of the key catalysts to look out for is at its annual general meeting, where guidance will be in focus. Corporate Travel reiterated its FY19 EBITDA guidance of between $144 to $150 million, but Morgan's does believe that this is conservative. PWR Holdings, no change to its high conviction stance on this particular company. And Kina Securities is an interesting one. This is a diversified financial services provider in Papua New Guinea. Morgan's believes that it's on the path to a re-rating. They expect this company to come out with a record profit, and yet it still trades at a discount to its initial public offering price. In terms of ERM, the key here is the gross margin performance, and Sundance Energy new production wells are the key catalysts, but attract attractive leverage to that energy space. So plenty of ideas to finish up this weekly wrap. Hopefully the volatility in terms of the markets calms down this week as we refocus on US third quarter earnings, where growth of 19.2% is expected by the market. I'm Julia Lee, equity strategist at Bell Direct. Hope to see you next week.